All right, so let's begin the show. So, what's the way ahead for the markets? Market experts and fund houses have their own view, and what's in store, especially for Kotak AMC. I discussed this with Shibani Sircar Kurian, Senior Executive Vice President, Fund Manager, and Head Equity Research, Kotak Mahindra Asset Management. Let's take a look. Shibani, thank you so much for joining in today on the Money Show, and it's a pleasure to have you. And your understanding of equity markets really helps our viewers in formulating their strategy for the portfolio. But then now going ahead and deeper in 2024, we want to understand what's the house view coming in, especially after the monetary policy, where we did not see any changes. Beginning of the year, we were expecting, or Fed was expecting, to cut down rates starting from March, but that also looks highly unlikely looking at the kind of data coming in from the US markets. What is your house view, and how are you looking at equity markets right now?
Hi, Kavita. Always a pleasure to be on your show. So, if you look at equity markets and we just take a step back and we see that three key factors have been driving Indian equity markets. One is the belief that policy continuity will be there, and therefore the overall work that has been done in terms of spurring investment-led growth. The second factor has been corporate earnings, and we are in the midst of the Q3 FY24 corporate earnings season, which has been progressing fairly well. And the third has been liquidity, which is essentially the domestic flows, which continue to be strong. Now, as you mentioned, in terms of the RBI policy, it is more of status quo. And our belief is that while inflation continues to be trending lower, and RBI expectation is that inflation would come off next year as well, the target inflation rate for RBI is 4%. And hence, from a policy perspective, RBI would possibly take cues from what the US Fed does and then look at any change in terms of the policy rate as such. So overall equity markets, if you look at while corporate earnings has been strong, we have to also take cognizance of where valuations are in the markets. In this sort of a perspective, if you look at large caps, the risk reward in terms of valuation still remain fairly favorable. Earnings growth remains strong, and large caps are trading at a slight premium to their long-term averages. Mid and small caps continue to deliver earnings, but trading at significantly higher than long-term averages. So our preference in this market is large caps over mid and small caps.
Also, Shibani, we are due for a budget again post-elections. But then, looking at the current interim budget, would you think it's good for an investor who already has a core portfolio to go maybe bullish on a few sectors? If you are someone who is very well established and knows the market, you can actually look at a sector fund based on the kind of announcement and thrusts that the government showed in the interim budget speech.
Yes, so if you look at the where we are positive on is the auto and the auto ancillary space. And fourthly, in terms of building material and real estate. So these are some of the domestic facing sectors where we continue to be positive on.
All right. There's also a Jan SIP data that I think should be highlighted, and maybe I would want your take also on it. So the number goes beyond 18,800 crores, although we did see a huge amount of outflow in the month of December, 11,100 crores. So looking at the SIP numbers now, it's very important to understand the kind of trajectory coming from tier 2 and tier 3. As per your house experience, although we have seen a very high outflow in the month of December, do you think the market volatility is something that an investor needs to keep in mind? You're investing via an SIP, you're participating in all levels of the market, obviously, but then you need to maybe rebalance your portfolio, and as suggested by you also, and the house view that you also mentioned is more towards large cap. Is it time for that for an SIP investor to consider?
See, for an SIP investor, the best part is that you are investing, as you correctly mentioned, at all levels of the market. So, keeping in mind your overall asset allocation, you should continue with where you are in terms of your SIP investments. So, if you look at today as a house view, our view is that if you look at your overall asset allocation bucket, we should be somewhat neutral in terms of equity allocations, given the fact that we've seen a significant run up in equities, and therefore some amount of consolidation or volatility cannot be ruled out in the near term, even while the medium term outlook remains strong. And as we were earlier discussing as well, in terms of asset allocation, some tilt towards large cap over mid and small caps. But if you have SIPs running, then obviously from an SIP perspective, the SIPs make sense because you are investing across market volatility and market time periods. So that is pretty much taken care of.
One last question. Red flags for us going ahead. Although it's going to be election month now, next few months, if I have to consider. But as far as our markets are concerned, what are red flags in your mind?
So few key risk factors, and obviously from an equity market participant, always keep an eye out for risks that can emerge. One is that geopolitically there is a considerable amount of tension, and that geopolitical tension does not seem to be coming off, and therefore keep an eye on that in terms of its impact from our market perspective. The second is the global interest rate cycle. As you know, in the beginning of the conversation, we were discussing on monetary policy as well. The market seemed to have factored in that Fed will start cutting rates, and then we saw Fed commentary, which kind of has resulted in market pushing out the Fed rate cut or the pivot of the Fed as such. So the monetary policy cycle is something that would have a bearing in terms of equity market and valuations across the world. And the third factor for us specifically is corporate earnings. So far, so good. In fact, even in this quarter, if you look at corporate earnings trajectory headline level, Nifty continues to deliver in line with expectation. And therefore, earnings growth for FY24 and 25 seem to be fairly intact as of now in terms of earnings expectation. So these are three key factors and risks that we would continue to watch out for. And finally, if I may just end by saying that a lot of the growth that we have seen so far has been driven by premiumization or at the top end in terms of demand, while mass consumption has been lagging. And therefore, how soon does mass consumption pick up and start tracking the growth that we've seen at the top end would also have a bearing in terms of how markets pan out.
All right, that will be all. Thank you so much, Shivani. Always a pleasure to have you on the show. And thank you so much for directing our viewers today as far as the investment portfolio is concerned. Thank you so much.
Thank you so much.